So this coverage now, like a globalization of all of most of the transactions, that it poses actually like some problems with some regulators, because you need to cooperate with some with other countries when it comes to that, with the transfer of funds like that. So well, it's really a lot of challenge in the for the regulators to put some policies of the transfer of funds, um, because a lot of things are created actually, like the Bitcoin, and not only the Bitcoin. That's one of that. It's a virtual money, and I don't know if how to do that, but that's the problem now for the part of the government and international community. Now, um, factors to complete the combination include the different structures, nations, banking, and securities industries because of international transfers, conversions like that. So very easy with the app. It's some difficulty really to regulate that. The trend toward financial services conglomerates obscures development space market segments. Yeah. Financial services conglomerates. It's like, yeah, it's really complicated. It takes a lot of companies like that, and you cannot pinpoint the a lot of various market segments are developed. So the financial markets is getting more complicated actually as before, far from before. The reluctance of individual countries to give up control of their national monetary policies. That's one. May not cooperate. Like for instance, you have some, like for instance, Russia. So how can you do that? Well, China like that, and other countries that are allied with the China. So how can you negotiate or doing something in order to take control of the monetary policies? Um, Another important trend in recent years is the derivative. It's just derivatives. It's like as early as 2000. There's derivatives already, and derivative is any security that is derived. So this is complicated. Why? Because that's why it calls derivative, because it's another security wherein there is no actually a the value of that is depending upon the value of another security or another value of commodity. So, well, the concept is just like with the securities, like for the stocks, the value of the stocks is depending upon the value of the company itself. So, if the company is working hard and they are deciding smartly, or they have some good decisions, so it makes the value of the stocks derives from there. And but the value of the stocks is depending upon the speculation made by some investors. So the the derivative is another layer. So the stocks could be the sub, what in the underlying commodity of the derivative, where the derivative is deriving its value from the stocks. So it's another layer. So very for instance, example of derivatives is like the call option or the put option. Like for instance, you're going to sell the what you call this one, the securities. You can secure the contract of selling that by buying the put option. However, the value of the put option, so of course, put option has the initial value. Let's say $100. You obtain the contract to deliver like 1,000 shares of stocks worth like a million, and the put option is, let's say, the value is $1,000. At the beginning, that's 1,000. But however, is, let's say, if the transaction is not favorable on your part as seller, your 1,000 will become less than 1,000. If it will become more than that, then your 1,000 is 1,000. Whatever is the gain will be reflected on the part of the on the securities of stocks. Let's say you're 1 million today. Later, when you execute the sale of the securities, it became 1,100,000. Then you have a gain. But however, if the value of the stocks before the selling transactions uh, come into come into that date, um, let's say the value is it turned into, let's say, 950,000, then the value of your option will be affected by the loss incurred by that security. So it now it's the same. Let's say if your value at first is 1,000, then now it would be $950. So it's the same way as what the value of the stocks that have you lost. So that's the point of the derivative. It's more complicated. And this example is similar with what I told earlier, but in here it's a credit default swap. Let's say the bank has to protect itself from the loan that he he provided that it provided to the borrower. So the bank, in order to protect itself that might the borrower will not pay in the future, so he entered into the financial institutions that whatever the amount that is in default, the financial institution agrees to pay for that. However, with that security, there is that credit default swap is to be paid by the bank. So if the credit default swap is getting favorable in the future for the bank, let's say there was a default, uh, there was a likelihood that the payment is in default. The bank will pay for that, and that would make the value of the default swap. So however, if you cannot utilize all the default swap in the future, then well, that is a cost in the part of the bank. Okay. And interestingly, the credit default swap, as you can see from 2001, it grew like 60 times until in 6 years. So very amazing, right? Almost 10 years later, the market is only at 10 trillion due to the impact of financial crisis. It went down after third year, so it went up 60 times in 2007 after 6 years. Then after 4 years, it went 10 million, like 10 times only because of the financial crisis. However, until now, like credit default swap market is currently experiencing renewed growth due to recent market volatility. So it's still important on the part of some banks because it serves as security on their part.